All right, guys, so video number 3, we are looking at charts. So how do we lay out our charts as traders? What do we position? How do we trade? Who's our provider? And that kind of stuff. So the first thing is the time frames. I alluded to this earlier in the first video, but if you're scalping, you don't want to be trading off a 1 hour chart. You don't want to be trading off a daily, a 15, maybe a 5, but in reality, you want the smallest time frame that you can handle. Why is that? Because as a scalper, you want to be there to trade and you want the most detail you can have in that small window. 5 minutes is a long time when a scalper like you is looking for an entry or an exit. So if you're waiting for a whole candle to move, you're probably not going to get the same information. Well, you definitely aren't going to get the same information, but you're not going to get the same feel for it as you would if you're trading off a 1 minute chart and you've got 5 separate candles. Because you can see, okay, market's pushed up a bit, oh, it's pulled back, oh, it's reversed. And yes, I appreciate if you're watching the 5 minute candle, you'll be able to see that go up and down on the candle before it finally prints and closes the candle. But the point is, you want to go as kind of narrow as you possibly can when you're scalping, because that's where the edge lies, guys. The whole point of scalping is that you're using a short-term retail trader's edge, the ability that you don't have massive size to throw in and out of the market. You can trade in and out quickly and have no effect on the market at all. And so you want to leverage on that by, going right down as granular as possible. You can even go down into a tick chart. One tick's going to be probably way too much because it'll just fill the screen, but have a play around with it. If your charting provider allows you to show the chart in ticks, try something like a 50 tick, a 100 tick. Now that's going to vary depending on the market you're trading as to how much information or not that is, but try that. The point is, your layout is, like I said, you've got the higher time frames that you're perhaps making the decision about where you're going to do business. Okay, so you're saying to yourself, right, these are the levels that I want to do business at for whatever reason. We'll get to that point later, your strategy, but those are the levels I want to do business at. I want to position long or position short. That's then done. As a scalper, now you're looking to trade off that level. Now, the difference between scalping and day trading and swing trading is that swing trader or day trader will be like, okay, that's the level I want to buy at, and I'm looking for it to push off there and to go into a new fresh trend for multiple weeks, multiple days, or multiple hours, depending on which, where we are on the kind of timeline of traders there. But a scalper, all a scalper is saying is, I think there'll be some kind of reaction at that level that I can jump on, whether that is a pop off a level I can jump on, whether that's a jump, a breakthrough that I can jump on, whether it's a pop off I can fade. They are saying that there's going to be something that happens at that level that I want to capture. So it's a different approach. And so when you're looking at a bigger time frame, you're highlighting the areas you want to do business. You've already got a plan and strategy for those areas. And so that's when your layouts come into play. Higher time frame, drill down. Okay, I'm going to do business at this level. And then you've got that very, very, very close small time frame to fine tune that entry, that little long stretch you want to fade, that little flurry you want to follow, that little kind of pause after. If you've ever tried scalping, you kind of know what I'm talking about. That little break, the little pause just sits there and tickles, and it's 15 seconds, but that's the scalper's entry. Like, right, that's a 15-second pause to get on because it's not pop back up, bang, smack it short, look for the drive lower, come out, take your 15 ticks, move on, next. That's the name of the game with the scalping, guys. Right. Number 3 is the provider. So you really want to make sure that you've got a solid charting provider. Now, listen, guys, Tradingview is probably good enough. Tradingview.com is probably good enough. Reasonably cheap, but I think it's free for Forex, but you can pay for the exchange to get all the stuff that you need. Pretty decent, web-based. I say it's relatively new. It's probably 5 years old now, but relatively new compared to the likes of like eSignal and Tradestation. If you want to go all out, then by all means go all out. But I would say, my advice would be to go one step up from your broker's charts. Your broker's charts are they're all okay, and everyone says, no, they're fine. Personally, I like to have a separation there. I like to say, okay, my broker's charts are there and they're probably good and they do all the time frames I want and stuff, but I just like having an independent feed from somebody who's making money from supplying me with an accurate feed, as opposed to somebody who's making money from my trades or my commissions, and it's kind of a sideline, the active feed, the price feed. So try something like that. Maybe there's Ninja Trader. We've got Ninja Trader, Tradestation, Tradingview, eSignal. There are others out there, Market Delta. We've got a sea of providers here. We're not going to kind of review all the providers here, but just go with one that does the job. I like Tradingview. I have tried probably all of those on that list. eSignal, super expensive when I had it years ago, multiple $100s a month. Tradestation, very good platform. Probably unnecessary now with Tradingview, depending on what you're doing, but that's very good. Ninja Trader, very good once you get it all set up. I'm sure it's improved loads as well, but Tradingview has been my kind of go-to staple since it started, so that's a good thing. Right. Now, the thing I want to touch on here, futures, CFD, Spreadbet, not necessarily going into how we're going to trade that. We'll touch on that in a moment. But if you're trading, specifically from the UK, you'll be trading probably a spread bet. And let's say we're spread betting the DAX. Now, currencies is a little bit different. It doesn't need to apply for this, but this is specifically for maybe indices or commodities. If you're trading, let's say the DAX or the Dow, you're spread betting the spread betting companies price, if you like. So for example, they might call it the German 30. They can't call it the DAX for regulatory reasons because it's not the DAX, but it will mirror the DAX cash. Now, we know we can't trade the DAX cash. We have to trade the DAX futures. And so this is where it starts to get a little bit complicated. Once you've got your head around it, it's fine. It's okay, so the spread betting price mirrors the DAX cash, but it goes off the DAX futures. Yes, so let me explain to you. So the DAX futures are the futures price that you could trade if you went direct to Eurex and traded it on the exchange. Put your order in, you trade it, off you go. DAX cash is a price made up of all the components, constituents in that DAX. Same as the Dow, same as the S&P 500. Constituents go in, make up that index price. You can't trade that because it's just purely an index price. You can't trade it directly. So the spread betting companies, what they do is they will use the futures price as a reference point, because you can trade that, but they will adjust it to make it appear like it's a cash price. They'll make their own adjustments on it. So it will probably trade and be the same kind of price. Let's say it's 11,400 cash. The price you can trade on a spread bet or a CFD will be 11,400, but it will move in line with the futures. So the futures go up 20 ticks, that will go to 11,420, and you'll notice the cash might be delayed or lagged. The actual official cash price is why you can't trade it generally. So what does that mean for your charts? It means that if you're spread betting or if you're trading via a CFD, you're better to have the front month futures contract up for the commodity or index you're trading. This doesn't apply for Forex, guys, because Forex is a different animal. It doesn't apply for shares either. But if you're trading Dow, DAX, and we'll list all these over and later on and go to the pros and cons, but let's say the big ones: Dow, DAX, S&P 500, NASDAQ, FTSE, crude oil, natural gas, gold, silver. No, keep that list like that for now. You need to have the front month futures contract up. That will give you the pattern that you need. And then if you're trading a spread bet or a CFD with your provider and you're not going directly to the exchange, you will be adjusted for the cash price. So you kind of got to get used to this. Once you do, it's no problem at all. It's something that I've done for 10, 15 years, trading that way, looking at the futures contract, but trading the actual cash price via a spread bet or a CFD. But just that's the way to do it. You want to have that futures price because that will show you the price spikes as well, and that will be mirrored in the actual futures or spread bet contract, but the price will be slightly different. So the price will be slightly adjusted and it will look like it's a cash price. So that's just something to think about, guys. If you're trading from a traditional charting provider from the US and you're trading a UK CFD spread bet, or maybe if you're European CFD, not spread bet, it might be adjusted like that. So that's just one way to set it out. Okay, number 5. Link markets. I think I touched on this earlier. If the markets are moving based on other markets' influence, then you need to have those up there. And I call them the market's engine. If the market's engine is crude oil, because everyone cares about the oil price, you must have a crude oil price up there on your chart. If it's worried about gold or it's worried about yen, and I've been traded through cycles where it's always been something. There's always something everyone's looking at. It might be the yen, it might be dollar for Brexit, it might be pound for Brexit, it might be dollar for elections, it might be you get the idea. What is fueling the whole markets or people's decision-making process? You want to have that up there. And another link markets that are obvious link. Like if you're trading silver, you probably want to have gold up there. You might want to have copper up there. You might want to have platinum. If you're trading the softs, you might want to have some other soft commodities on there. You get the point. And the final thing is making the decision whether or not you want to have news up there. Now that's just going to be a decision for you based on your style and strategy. But if you have news on there, then you may well be heads up or given a heads up for something that could be market moving, especially if it's new news. Now, the releases that are scheduled, not so much so. You're not going to beat the guys who have got that direct feed and their algorithm that is scanning it and moving the price accordingly. But you have got an equal footing when, let's say, something comes out that's unexpected. Maybe it's a tragedy or a good thing, or just generally around that stock or around that market, around that asset. And you can use something like Twitter as well if you don't want to pay for a news feed. But having that there sometimes gives context to some of the moves if you need it. And I just kind of say treat it with caution, because it's not always useful. In fact, it can be quite a hindrance at times, but it's there nevertheless.